Hey guys, good morning. So here's the promised explained lecture. I'll try to talk about the key points here for you, keep things moving, try to help you isolate what's most important to be successful with this. This lecture, savings and investment, when we talk about it, it's not so much talking about personal savings, but more so it's talking about on the aggregate level. So when the United States as a whole saves money, how does that affect the way that people borrow money? And ultimately, as it says on the slide right here, this is kind of how we determine interest rates. So understanding a lot about what's going on right now in the world and understanding about, college loans, auto loans, things like that. A lot of it actually stems from this. So it's helpful stuff to go through. However, it's pretty tricky, so I'll try to just consolidate and make it the most important bits and pieces you need to know to be successful. And then before the end of this, I'll make sure to kind of go over real quick your assignments so you know exactly what's expected out of you. It's simpler than it looks, so don't panic, but we'll get there. So breezing through this here, this we've already talked about. This is straightforward. The first thing we're going to do is kind of define what savings are. So of course that's what individual households save. That's what you put in your savings account or your parents or whatever that might be. It does also include foreign investments. So, as being the United States, we're blessed to have a lot of countries that actually house money with us because if you're from Venezuela and you have money, you can't trust it too much. But if you send that money to the United States, it's much more stable and it stores its value in a much more predictable way. And then, of course, as money comes into banks, the role of the bank is to lend that money back out. But we're going to kind of extrapolate that point more in a couple weeks here when we talk about the role of banks. When we talk about investment, we're mostly talking about physical investment by businesses. So, not investing in the stock market, not investing in bonds and options tradings, but what do businesses actually take out loans for to invest in themselves? Of course, this goes for residential, same thing. A home renovation would be an investment made. And then, of course, as we talked about, it does also include things like human capital and technology, but physical capital tends to be the easiest one to keep track of. So, the spending identity, this is kind of the big relationship that goes on between what we put in the bank and then what do people borrow. We try to look at that at the national level. When we talk about things like a budget deficit and stuff like that, that's where all of this comes into play. So, national savings equals private savings plus government savings. So, what you and I put in the bank plus what the government puts aside is what we represent as what the country saves on any given year. If the government has a surplus, we know that it brought in more money than it spent. That never happens in the United States, but we'll pretend. And of course, the deficit. That's something we're much more familiar with. Now, investment spending is really where we try to couple this up. So I'm going to skip ahead to right here where we can show this. In a closed economy, we only are allowed to invest in what we have already saved. I hope that makes sense in simple terms, but to borrow money, there has to be money to borrow from. So whenever we have savings, we can always usually equate that balance by saying we have a comparable or equal amount of investment going on. Now, when you open the economy up, like how it actually is, where you have trade and foreign investment, that's where things begin to get a little bit different. So on this one here, we say the U.S. has savings in 2012 equal to 3,000 billion, so 3 trillion and change. Of course, we had a budget deficit that year, shocker. But we also had capital inflow. Now, here's the big thing. We talk about the federal deficit and how much money we owe to China, and everyone, freaks out. I mean, yes, it's scary, of course, and it should be freaked out about. But you have to keep in mind that when we do accounting at the national level, we're talking about the things that come into this country too. So capital inflow is a big part of it. It obviously doesn't offset our deficit, but it helps to kind of mitigate the damage that would be. Now, when you look at investment, If you look at the math right here, and I have it broken down on the screen for you right here, estimated investment was about 2,500 billion, slightly more than savings, but that's just data collection stuff. It's actually not the theory. So as the country as a whole, we spent what we saved in 2012, and the data really does check out year over year. Of course, the deficit still brings us down, but on average, what we put away is what we invest, and that kind of defines an open market economy. So knowing that savings and investment kind of equal each other and they have this relationship, we try to quantify it in what we call the loanable funds market. Savers, people like us, and borrowers, people who like to take out loans, they kind of meet in this hypothetical market, and this is where, as simple as it sounds, we determine interest rates for the entire country and the entire world. The structure of this graph is set up in the same exact way as any other graph we've done. We've got our downward sloping demand curve. We've got our upward sloping supply curve. And the big thing to be aware of here is that we're talking about the demand and the supply of loanable funds, right? So when we say the supply of loanable funds, what we're saying is how much money has been put into banks by savers that is available. When we say the demand of loanable funds, we're saying how much money is being demanded by people who want to invest in things, whether it be businesses or homes and things of that nature. So when we change this loanable funds relationship is actually where we see changes in the interest rate. So let's say demand increases. If demand for loanable funds increases, then the quantity will rise to meet it. And when people want more of something, you'll remember, it comes at a higher price. So we see interest rates go up. If people aren't demanding money, if businesses don't want to take out new loans, well, then demand's going to fall. And how do we kind of encourage people to borrow money? You lower interest rates. And we can see that graphically here. Now, of course, changes in supply work in the same way. Let's say everyone gets their stimulus check here that the government's talking about. When people get more money, they have a greater supply of loanable funds. Let's say they put it in the bank. That would actually drive down interest rates further, right? There would be an increase in supply of loanable funds, which would mean that therefore there's more to take from. And alternatively, let's say there's a decrease in the supply of loanable funds. It's harder to find money, therefore it comes at a premium. Now, crowding out is kind of the last big thing that goes with it. Knowing that the availability of loanable funds is kind of what makes interest rates, you have to consider that people aren't the only ones that borrow money. When the government decides to take on a huge project and put people to work, that money has to come from somewhere, and it's reflected in this market. So we refer to that as crowding out. So let's say that during a budget deficit, like we're in, the government decides to borrow money to give people jobs or start a project, right? That would, borrowing money, cause the interest rate to go up. But notice that that doesn't mean that businesses are taking out money, right? It just means the government borrowed money. Therefore, when a private company steps in to try to get a loan, they're subject to a higher interest rate only because the government is the entity that took up all the money. So we call that crowding out. When we know that this is a market that operates on supply and demand, if the government consumes a large chunk of it, they may manipulate the interest rate, and in doing so, they could actually keep out other people from taking loans. They could give a disincentive for businesses to do this. It does work on the flip side too, though. Maybe this is something that we'll see take place here. If the government cuts taxes or they give a stimulus check, when they increase that supply of loanable funds, they actually decrease it and can help incur more borrowing at a lower rate. So with that being said, I'm going to switch up here real quick and pull up the assignment that y'all are going to be working on. You'll see it right here. All I ask you to do is kind of look at a few fictitious headlines here and then try to determine how you think that would change either supply or demand, and then say what would happen to interest rates. So I did the first one for you here. I say, consumer incomes rise, more people are saving money. Knowing that, I'm going to say, more people are saving money. That's probably going to increase the supply of loanable funds. So my red line here is going to shift down and to the right. Is demand going to be changed? I don't think so. I think it's just a supply side thing. So I'm going to go and highlight no change. It's right up here. So when you do this, just go highlight. You can pick any color that makes you happy. How is supply affected? Well, it increased, right? People are saving more money, so this line's going to move here. I'll highlight this one. C, you obviously don't have to do. I can't make you draw on these graphs, so just consider it yourself. How would the interest rate be changed? Well, demand stayed the same, but supply shifted somewhere down here. So it looks like we would have gone from like 7% interest to, let's just hypothetically say 4%. So the interest rate would decrease. I would highlight that one. And then how has quantity changed? Well, we went further down along the demand curve to the right. So let's say we go from 800 billion to 1 trillion here. So I would highlight increased. You'll do the same thing for 2, 3, and 4, just different scenarios, different changes. For number 5, I asked you to create your own headline and then kind of summarize how it would change. And then these last 2 questions, 6 and 7, very difficult, very higher order. I'm just asking you to try your best on it. It's really based on what we just talked about and a reflection about how it may be playing out for us right now in 2020. As always, any questions, let me know. We're going to have a Zoom on Thursday, time to be determined. We'll talk about these things, and then on Friday, we'll do the quiz. Hopefully you're doing great with this. As long as you're keeping up, man, I'm going to make sure you stay afloat, make sure you get out of this, and hopefully we're going to see you guys walking in June.